Hello everyone, and thank you for joining us on Wealth Matters for Physicians by Altfest Personal Wealth Management. I'm Mike Prendergast, a director here at Altfest and host of this channel, which is focused on providing physicians with investing and personal financial planning insights to help them achieve their important financial and life goals. Before we introduce today's guest, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective and fee-transparent manner, while as a fiduciary always putting their best interests first. We are honored to be the preferred wealth manager for members of the Medical Society of the State of New York, the preferred wealth management education provider for both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, and a corporate partner of the Medical Society of New Jersey, amongst other associations. Our guest today is my colleague, Jessica Nelson. Jessica is a financial advisor at Altfest Personal Wealth Management, where she helps our clients optimize their investments and all other areas of their personal financial lives. Jessica is a CPA, a certified financial planner, and has a master's in financial management. This is the first of 2 videos with Jessica on tax saving strategies for 2002. Tax season can be filled with anxiety and confusion, and 2022 probably won't be any different. Today I will be discussing with Jessica Nelson a variety of tax saving strategies related to investing, health savings accounts, and business owners, just to name a few. I think that you will find her tax insights very beneficial. Jessica, thank you very much for being with us today on Wealth Matters for Physicians.
Of course, thank you for having me.
Excellent, excellent. Well, before we go into taxes, why don't we let our physician audience get to know you a little bit by asking a few questions. So first of all, what got you interested in going into wealth management?
Yeah, definitely. So before I was in wealth management, I actually worked in public accounting, and I was doing accounting for high net worth individuals, and it was great, but then I found myself only seeing one part of their finances, right? And then I was like, hey, I know there's a bigger story behind it. Because the way I look at tax returns, I'm like, this is not just a piece of paper. This is a story of someone's life and how they manage their finances. And I was like, I want to get more into the details. And then that's when I discovered wealth management. And I realized that that was the space for me.
Sounds excellent. Sounds excellent. Yes, that's one of the things that we really like at Altfest is that we can help optimize all the different areas of a physician's comprehensive wealth management picture.
Definitely.
Great. And how do you, I know you're very busy, and when you're not a tax and personal financial planning expert, what do you do in your free time? What do you like to do?
Well, a multitude of things, but I would say maybe the one I'm most passionate about is really just exploring the world through food. I love to eat, right? So one of my favorite things to do, especially living in New York, is I feel like every evening I can go to a different restaurant and feel like I'm in a different part of the world, whether it's I'm going to having Thai food, I'm going to an Indian restaurant, or whatever it may be. I feel like you could find so many pockets in the city. So that's one thing I really enjoy doing.
That sounds excellent. Yes, I know that we're very blessed in New York City to have the entire world, all the culinary experts of the world right at our doorstep.
Exactly.
Moving on to taxes, the first 2 topics are related to tax-efficient portfolio management. The first topic is contributing to a Roth IRA versus a traditional IRA. So just to start us out, can you briefly tell us what is a Roth IRA and what is a traditional IRA?
So to start out with the similarities, they're both retirement accounts, right? So they have that in common, but the difference is about when you pay taxes. So with a Roth IRA, you pay taxes before you contribute to it, but with a traditional IRA, you pay taxes when you withdraw from it.
So then at what time does it make sense tax-wise to contribute to a Roth IRA versus contributing to a traditional IRA? There might be different times of life when one might be more appropriate.
Yeah, exactly. So you want to consider where you are in your life cycle of earnings, right? So if you are more towards the lower end, maybe it's the beginning of your career and you're at the lowest marginal rate that you will ever be in, at that point, we want to do Roth because we're paying taxes at that lower rate. Now, if we're at the higher end of our career, maybe we have our own practice, it's doing really well, Then we want to do traditional, because we will save on taxes by paying during retirement when we make those distributions instead of paying taxes now.
Thank you very much. Okay, so let's talk about portfolio asset location. Not asset allocation, but the location of your assets. So could you tell us, what is this and why is this important to keep in mind regarding the tax efficiency of one's portfolio?
Yeah, definitely. So asset location is all about where you're placing your investments. So what type of account is it in? Is it in a tax deferred account, a tax exempt account, or a taxable account? And the reason this is important is because different type of investments come with different types of income, right? Some may pay more in dividends, more in interest, some may have more capital appreciation. So we really want to place investments in the vehicle that is best suited for it from a tax perspective.
Great. So could you give our physician audience some examples of investments that might be better suited to go into a taxable account versus a tax deferred account, and then maybe lastly a tax-free account like a Roth?
Yeah, definitely. So an example I like to use is with bonds. So let's say you are a higher earner and it makes sense for you to have municipal bonds because of some of the tax exempt features of it, right? For that type of account, we would want to put that in a taxable account. And the reason for that is we want to take advantage of that tax exemption. If we're putting that in a tax deferred account where it wouldn't have been taxed anyway, then that's almost a waste, right?
It doesn't seem to make any sense.
Yeah, exactly. So we want to put that in a taxable account. Now, if it's vice versa and this is a taxable bond, then maybe it makes more sense to put that in a tax deferred account, right? Because we don't want to have to pay that phantom income that may come from it.
Makes sense. Now we're going to talk about some tax efficient accounts that could make sense for you. The first is a health savings account. So many people in the audience, they probably heard the name health savings account, but aren't too clear about what it is. So can you explain, first of all, what is a health savings account?
Yeah, this is one of my favorite things to talk about because I feel like it's too often overlooked. A health savings account has one of the highest tax benefits that you can ever have. So what it is, it's an account that you can use for specific qualified health expenses. So the way this account works is people who are in high deductible health plans are able to contribute to this account. When you make your contributions, you actually get a tax deduction.
Wow.
Yeah. And what's great about these accounts is not that you just put money in and you can only use it for qualified health expenses. You can actually invest the funds in that account. So what many people do is almost use this as a retirement savings account, right? So maybe you're putting funds in there to save for health events while you're retired. So you go ahead, you get that tax deduction for contributing to it, you invest, it grows, and when you have a health event, you withdraw from that. What's great is your withdrawals, if it's a qualified event, are also tax-free. So this is one of the only accounts where you get that deduction for contributing to it, and you don't have to pay taxes when you withdraw from it.
That is really amazing. So like you said, if you withdraw for a qualified medical expense, you get a tax deduction up front and you don't pay any taxes when it goes out.
Exactly.
That is amazing. So you definitely talked about the benefits of this. So who is really eligible to participate in this? You said something about the type of health plan that they have?
Yes, so you have to be enrolled in a high deductible health plan in order to contribute to this account.
Great. And let's say you satisfy the requirement that you're enrolled in a high deductible health plan. How do you set up the account? Do you call your company's HR? Do you go to a brokerage firm and just say, I want to set up a health savings account? How does it work?
So what's great about this is many employers will help you set this up. And in fact, a lot of them will contribute on your behalf. So if you have a high deductible health plan and you're not contributing to your HSA, there's chances are that you're leaving free money on the table.
Are you saying that your company might be giving a match for dollars that you contribute into your health savings account?
Absolutely.
Wow.
Yes.
That is amazing.
It is. So if you have that, the first step is really to talk to your HR, talk to your benefits provider, and see if they have that. Now, if they don't, but you are still in a high deductible health plan, you can reach out to different custodians. Many of them offer them. So even if your employer doesn't have one set up for you, you can create one for yourself.
Good. So you could go to any of the many custodians, the Fidelities of the world, Charles Schwab, TD Ameritrade, and then just ask them to help you set it up.
Absolutely.
Wow. Jessica, that alone I think is worth the price of admission to this video. So now let's talk about another type of account, which may be appropriate for some people. And this is a donor advised fund. Now, I know that it has something to do with about charity, charitable giving. Can you start us off and tell us what is a donor advised fund and what's the reason one would want to have one?
Absolutely. So a donor advised fund is something that you would set up. And this would be something where you place your charitable contributions to. And then from that donor advised fund, you would then be able to distribute the different charitable contributions to various charities.
Excellent. I think, some people might just say though, that's nice, but why don't I just write a check and pay a check to this charity, a check to that charity? What's the extra benefit of a donor advised fund?
Yeah, so there are multiple benefits. So one is that you can almost front load your donor advised fund, right? And lump all of your charity or various amounts of your charity into 1 year. So let's say I want to donate to my church and I have a set amount that I want to give over the course of 10 years. Instead of having those checks, writing those checks out every 10 years, I can write one check for the lump sum of that it would have been for that 10 year, donate it to my donor advised fund in 1 year, and claim this large deduction for this 1 year. So if this is a very high earning year for me, and maybe next year's won't be, or if I'm afraid that maybe because of the higher standard deduction, I won't be able to itemize even given my contributions to my church for the next 10 years, what I can do is lump that in, make sure I get to itemize that deduction, and then later on, just take the standard deduction. And even though I'm contributing all of those funds in 1 year to the donor advised fund, my donor advised fund can then spread out my contributions to my church over 10 years.
That's a really good point, Jessica, because many people just write a check to a charity and then they don't get any tax benefit from it because they're not itemizing their deductions, because they're taking the standard deduction because it's pretty big right now.
Yeah.
So they're not getting any tax benefit. What I think you're telling us is that instead of writing these individual checks to charity, you might want to bunch them up, maybe give 4 years worth of donations, 6 years worth of donations, whatever your accountant thinks is most appropriate. And by doing that, you're going to get all of that big itemized deduction in 1 year, and that will make the totalized itemized deductions much higher than the standard deduction.
That is correct. That's exactly it.
That is excellent.
Yeah.
Great. Okay, Jessica. So once you've made a contribution into the donor advised fund, how does it work? Do the funds in there stay as cash? Can you invest them in certain things? Especially since it might be a while because you're making these individual grant requests for that large amount that you contributed in the first year.
Absolutely. So if you go ahead and you donate cash, you can absolutely invest the cash that you donated in that donor advised fund. And what's great about it is you can then give more to charity. So while that you can put that money to work and you can benefit your church, your school, whatever organization, even more than what you contributed. And what's also great about donor advised funds is you don't only have to contribute cash. You can actually contribute securities. And what we tell our clients to do is go ahead and contribute appreciated securities. Because by doing so, you're saving on taxes. Because if you were to go ahead and sell that security, you would then have to pay capital gains tax. And for some individuals, most individuals, you would also have to pay net investment income tax. So by donating appreciated securities, you're not only getting that higher itemized deduction, but you're also saving on capital gains tax, and you're helping the organization that you care about.
Wow, that was a mouthful, but it was a mouthful of great knowledge, so I hope everyone's paying attention. This is the end of our first video with Jessica Nelson. We look forward to you joining us for the conclusion of our interview with Jessica Nelson in our second video. If you would like to talk about reducing your taxes or anything else related to your investments or other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-406-0850 or by emailing Jesse at his email address, which is in the description of today's video below. If you like this video about providing insights to help physicians optimize their personal finances, please click the subscribe button below so you can receive notifications each time we release a new video. If you think that a fellow physician would like this video or find it interesting or useful, please feel free to share it with him or her. Lastly, as always, this channel is for you. We want to make it as useful and as enjoyable as possible. So if you have any topics you'd like us to cover in future videos, like or dislike something that we're doing right now, or have any other feedback, we would love to hear from you. So please share your comments in the comments section below. Thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and keep optimizing your finances.